right, the other big story today, of course, was the discussion paper on changes to how NBFCs, that is non-banking finance companies, are regulated, which the Reserve Bank of India put out. Remember, ET Now's Ruchi Bhatia had broken this story first last week, that there were regulations being considered and on the anvil. Now, a bit of context and background to what has been happening. After the IL&FS meltdown, concerns were rising about the role and impact that non-banking finance companies could have on the entire system, and an outsized impact because of the kind of dependence they have on banks as well. In fact, the financial sector is still reeling from what has happened with IL&FS. So a bit about what these regulations say. They look at distributing the clutch of NBFCs in the country right now into various buckets. So there's a base layer, there's a middle level, there will be a upper level, and there'll be a top level. The base level will have NBFCs with a smaller size of assets and less impact on the overall system, and less scrutiny as well. The middle level will be sort of more business as usual, will include the housing finance companies with a slightly more stricter regulation. The upper level will have the top 10 NBFCs in terms of size of their operations, and the regulations for them will be akin to banks. The topmost level is reserved for the troublemakers, if I may put it. It's empty as of now, and as per what this paper proposes, only those NBFCs which are very large and can have a risk on the entire system will then be pushed up to the top level and have even more scrutiny by the Reserve Bank. Now, to explain to us why this discussion paper is important, how it could change the entire financial system of this country, I am joined now by Mythili Bhusnurmath, consulting editor at ET Now. Mythili, great to have you on the show as always. Can you put into context for us why this discussion paper is so important? And if this goes through, is it likely to, for one? If it goes through, how does it impact the current financial system and NBFCs?
Tamanna, let me just try and put that a little bit in context. You know, my problem with the discussion paper really is that it's missing the wood for the trees. Because what is RBI's job? One of RBI's jobs is to ensure stability of the financial system. So we need to be clear, what do we mean by financial stability? Does it mean that no NBFC should be allowed to fail? No. What it means is that the failure of an NBFC should not have repercussions for the stability of the financial system. Hence the term systemic risk. So what do we mean by systemic risk, and why is this something that applies only to banks? All over the world, we never talk of systemic risks of shadow banks or NBFCs, only in the context of banks. This is because it is important to remember that it is only banks that take deposits repayable on demand. So the risk is that if one bank fails, the public may lose faith in banks in general and rush to withdraw their deposits from other banks too. And since bank deposits alone, and I repeat the word alone, are withdrawable on demand, other banks cannot refuse. But under the fractional reserve system that underlies modern banking, banks cannot possibly repay all their depositors if all of them rush to withdraw their money. Since the money is locked up in various loans which have different maturities and cannot be immediately, encashed. So in contrast to this, NBFCs are not allowed to take deposits repayable on demand. They in fact cannot take a deposit which is repayable for less than 1 year. So this is why a failure of an NBFC does not result in a run on other NBFCs. It can shake the confidence in NBFCs, but it cannot lead to a run. So if that is the case, and where is the root cause? Why is this worry about a systemic risk from the failure of an NBFC? It lies in the interconnectedness. That means the connectedness between banks and NBFCs, whereby as a result of which banks have such a huge exposure to NBFCs that it compromises their own safety. So this is what the working group, the discussion paper and RBI should focus on, nipping the interconnectedness between between banks and NBFCs. This is the solution. You limit the interconnectedness. You do not allow this interconnectedness to grow to such a large extent that today more than 50% of NBFC deposits comes from banks. That is not how it should be. So this is the solution. You reduce the interconnectedness. The solution is not to have more and more regulations, particularly when you're not able to enforce these regulations. Sorry, Tamanna, it's a long answer, but there's something I feel very strongly about, and I think the discussion paper is marking completely up the wrong track. You need to ensure that what are you trying to do? Does it serve the purpose, or are you merely having more and more regulations? If you want to protect the stability of the financial system, nip the interconnectedness between banks and NBFCs.
No, absolutely, Mythili, and it's important to explain, why this is required and why this conversation is happening right now. I get your point completely that the kind of dependence that NBFCs have on banks is what has upset the apple cart, so to speak. But having said that, in the current situation, isn't there a case for more scrutiny from the Reserve Bank of India, especially for the large NBFCs? Some of the things that they've put into place, for example, increasing, the net funds required, or increasing the threshold for entry, increasing the definition of what a large NBFC is, up to 1,000 crores. All of those were long overdue, isn't it?
That's true, but if you want to tighten regulations, then you must be consistent. Whereas what the discussion paper proposes is that in many cases, like in the case of exposure to real estate, exposure to the capital market, exposure for IPO financing, NBFCs are still free to do virtually what they want. So the report plays hot and cold. Either you tighten regulations and tighten them across the board, or you don't do this at all. Because today what you're doing is you're allowing NBFCs, even under the discussion paper's proposed measures, NBFCs will be allowed to do many things that banks are not allowed to do. So in effect, what is happening is that bank money is being used to fund NBFCs to do what banks themselves are not allowed to do. And this leads to a very unhappy situation. Like, let me give you a simple example. HDFC Bank, as we've seen, has reported stellar results. But its non-banking subsidiary, HDB Financial, has actually reported losses. So how can you have a system like this? So clearly there is a need to tighten regulations, but along with that, you need to be able to enforce those regulations. And when you cannot, and you know that the NBFCs are paying a higher rate of return only because of the higher risk, then what you need to do is to ensure that bank deposits remain safe. Because all over the world, taxpayer money is used to bail out banks. Taxpayer money is not used to bail out shadow banks, and it should not be allowed to do. Even under the Basel system, market discipline was one of the key pillars, and that is particularly applicable in the case of NBFCs, which is why I think this discussion paper is completely going off the wrong track. The RBI is trying to do what it simply cannot. Your responsibility for financial stability is to ensure that systemic risk is minimized. And that is best done by ensuring that the banking system is safe, because that is part of the payment systems. NBFCs cannot issue checks. They cannot create money. Banks create money, which is why everywhere in economic literature all over the world, banks are treated as a very different kind of animal, neither fish nor fowl. And you have licensing of banks, you have registration. For every bank, the RBI sees is the promoter fit and proper. No such scrutiny is done in the case of a promoter of an NBFC. The flexibility is given precisely to allow higher risk to go with higher reward. And I think once we lose sight of that, we're really barking up the wrong tree.
All right. So the discussion paper warrants different opinions, and here's a very strong and clear one coming in from Mythili Bhusnurmath this evening. Thank you so much, Mythili, for joining us, and as always explaining very simply and beautifully what the larger picture is.